Due to sanctions, Russia is unlikely to be able to pay its debts in 2022. And this is worrying investors. Could this lead to the country defaulting? And how would that affect Russia? And more importantly, how would that affect the rest of the world? The markets have little confidence that Russian debts will be repaid. And Russian bonds are now trading as low as 20 cents on the dollar. Credit rating agencies have slashed Russian bonds from investment grade to junk status, saying that a default is imminent. Most countries can't pay their bills purely through taxes, so they raise money by issuing government bonds with a promise to pay back the value of the bond with interest. It's basically a loan to a country. A default happens when a country can't pay back this loan. A majority of Russia's debt is internal debt that has been issued to domestic investors and institutions. As of the end of January, this stood at $200 billion. However, Russia also has roughly $40 billion in international debt, split across 15 bonds, denominated in dollars and euros. Russia recently made its first interest payment since the invasion of Ukraine, but this is far from the only payment that Russia needs to make this year. Just in the next month, Russia needs to pay roughly $2.5 billion. And what's unique in this situation is that Russia actually has the economic ability to pay, but sanctions have frozen Russia's foreign currency reserves, making it technically impossible to pay. Putin says that he can pay in rubles, but the bond's terms state that bonds denominated in dollars and euros must be paid in that currency or Russia will be forced into default. In the 90s, Russia decided to benchmark the ruble to the US dollar, also known as pegging their currency. In the currency markets, there are basically two options regarding a country's currency. Either a currency can be free float, where markets decide how much a currency is worth compared to other currencies in the world, and this is the global standard. Or it can be pegged to another currency. Russia decided that $1 will be worth roughly 5 to 7 rubles. The problem with a peg is if the currency weakens, the country needs to spend money buying back the currency in international markets to keep the peg stable. Russia's problems started in the mid-90s when Russia invaded Chechnya, a former Soviet nation that Russia wanted to regain sovereignty of. The invasion was very costly and ended up costing Russia roughly $5.5 billion. This coincided with the price of oil plummeting below $20 a barrel in 1997 to 1998. Russia was and still is very dependent on export of oil for income. The combination of accelerating debt and falling income put a lot of pressure on the ruble, and it cost Russia billions of dollars to maintain their peg. In 1998, Russia defaulted on their domestic debt and eventually abandoned its US dollar peg, which resulted in the ruble plummeting in value, one of the worst recessions in Russian history, and inflation rates over 100%. Since many countries still buy commodities like gas and oil from Russia, there is still some demand for the ruble. However, these countries are quickly cutting their dependency on Russia and the ruble. The currency markets work under supply and demand. When no one wants a currency, the value deteriorates. And the Russian default would make the ruble even less attractive to investors, and the value would deteriorate even more. Russia still imports a lot of goods, now mainly from China and other parts of Asia since they've been cut off from the West. And when the ruble's value goes down, it will drive up prices for all these items, which will accelerate domestic inflation. Russia already raised interest rates to 20% at the start of the Ukraine invasion, and it's very likely that they will need to keep raising interest rates in an attempt to stave off inflation. High interest rates, runaway inflation, and a weak currency causes a vicious cycle in the economy, which tend to lead to a deep recession. This is a special situation since Russia is not technically bankrupt, they just can't pay off their debts due to sanctions. In a normal default, debt holders would negotiate with the company or country defaulting to reach a restructuring deal to get their money back. But since Russia has been shunned from the international stage, reaching such a deal is highly improbable, and investors will most likely need to write off their investments as losses. And if the state defaults, it can trigger a domino effect where Russian companies follow. Russian corporate debt now exceeds $120 billion, and US banks own roughly $15 billion of it, and European banks roughly $80 billion of it. We've already seen asset management firm BlackRock reduce their exposure from $19 billion to $1 billion in Russian assets, and this has mainly been through write-offs. And the Russian debt default could trigger a tidal wave of Western investors needing to write off losses, not being able to meet their own obligations, which might trigger a forced sale of assets. Technically, investors could lobby in international courts to get their money back. That's what Elliott Management did after Argentina defaulted in 2001. But it took them 15 years to get their money. A bigger issue than debt repayment is the dislocation of the Russian economy from the rest of the world. Putin has started enforcing counter-sanctions toward the West and withdrawing the country from the international stage. Russia supplies a large amount of oil, gas, food, and metals to Europe and the rest of the world, and the prices of these are soaring. This supply contraction will hurt the global economy far more than a Russian default. Many countries are already experiencing multi-decade highs in inflation, and this could exacerbate the problem. While Russia defaulted on domestic debt in 1998, it still kept paying its international debts. If they failed to repay these now, it would be the first time since 1917 when the Bolsheviks refused to recognize the overthrown Tsar's debts. History has shown that even expected events have ripple effects, with hard to predict consequences. Are we seeing the beginning of the next financial crisis? To fully understand what's going on and how it affects you, you have to watch this next video.